Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
There we go. I like realized at the last second that I had turned the microphone down. Okay. How's that? Man. And so because I was doing that, don't have the music going. All right, guys. Hey, Octavius, where have you been? You weren't gone that long. You're just like you missed like a day, right? Anyways, let's go to the charts. Look at what's going on. The open here looks pretty lackluster in the treasuries. So here in the treasuries, they were kind of down on Monday, and then basically ever since then, it's been a slow, gentle slope up. S&P 500 also like pretty sideways. Much more, yeah, that's pretty tight for the S&P 500 these days, right? Oil, well, it's struggling along, but let's say that it's within a range at the moment. Gold and silver still in pretty clear trending territory. I don't know. That one kind of looks like that's going to have to take a break soon, though. Kappa. Right up there. Japanese yen. Well, they had a little bit of a bump in the Japanese yen, but they're still struggling. The dollar down just a little bit. 103.6. Bitcoin had that jump yesterday. Coming back. I find it interesting. Bitcoin is like one of the most interesting assets to me right now. I don't think that I would like be in it or trading it or anything, but like it's just not doing anything. It's just not. It's not getting its mojo back. Like after the ETFs went and they went higher, I kind of thought, oh, maybe this is where Bitcoin takes off and it starts to get crazy again. But it's not happening. It seems like the public is just not interested in it anymore. And so instead, it's kind of doing some interesting things within the larger macroeconomic framework, I guess you could say. And it's kind of not what it was before. And so now this time, gold and silver is taking off instead. Yes. Red papers. So first of all, good morning, Uzi. Good morning. You don't have to know. You don't have to know says I read paper from Jean-Philippe Bouchot, and find it interesting that he says markets are inefficient and markets move by order flow, trend following, and these kinds of things. Yes, exactly. Well, so when you really get down, here's what my understanding of his journey has been. Okay, he was a physics guy. He was like a physics PhD or something like that, and then got sucked into the trading. And his work, what made him like a very valuable at first, and like his valuable contributions were in the field of time series analysis. So in particular, being able to analyze like 100 different time series against each other to see what their correlations are and come up with an optimal portfolio for trend following. Those were the sorts of things that Jean-Philippe did, right? And I think that what happened, so he doesn't say this, but just going off of like his research and like following how it's gone and everything else like that, he basically stopped and he said, this doesn't make any sense. How are we making money hand over fist doing this momentum strategy? It doesn't make any sense. And so he started digging deeper and deeper and deeper into the way the market works at its most fundamental level until he found a suitable explanation for why the momentum strategies worked the way that they did. And what he found, I think, was very surprising, because everybody thought that momentum worked just because like everybody was following everybody else. But when you actually try and model that sort of a thing where, you know, because there are things in physics where, like, for instance, like fission reactions, right? There's a fission reaction, some molecules go shooting off and hit the other molecule, and then that one goes off, and as you bring the molecules denser and denser together, the more likely that is to happen, and all of that sort of stuff, right? They use those models, and it did not reproduce all of the stylized behaviors that we see in the market, so weren't able to do it. So they took a step back and they said, well, maybe it's not everybody following everybody else. Maybe it's just like one guy could be in an asset and is just so big that they move it consistently over time. And when they started to model that, it made a lot more sense. So then they went and they got data from actual like banks, and they found this square root law, and it was just kind of developed from there. And then they started to look at, okay, how does the order book in itself create this square root law? And that's where we kind of came to how momentum works. So it's all very, very, very fascinating. And it really, I mean, that's the big thing about it too, is that you come into markets. I know this was certainly the case for me, with certain kind of misconceptions, like that are kind of ingrained into us by our culture, particularly in the United States itself. And there are some like contradictions in that. There's some things about it that don't make sense. So I remember when I first started always being like, well, okay, so if more people want to buy it, then it will go up. If more people want to sell it, then it will go down. But how exactly does that work? Like if I see a stock go down, but then people are actually buying against that move down, how do I see that? How do I understand that? Why does it behave the way that it does, right? Because all I had was stock charts, and all I had was what, you know, I had read on the internet in like technical analysis books. They don't explain that stuff, right? It wasn't until I got into the order flow where they started to say, oh, okay, it's the market order. Market buy gets matched up against the limit sells that are sitting there waiting. So if the market buys overwhelm the number of limit sells at that price, that's when price moves up. And so it's not necessarily that there's more buyers than there are sellers, but that the buyers are more aggressive, essentially, right? And the deeper I got into the order flow stuff, you know, it just kind of started to answer all of those kinds of mysteries to the point where there's just a lot less mysteries about the market to me, right? Now part of it is that it is random, so it's still interesting and engaging in that respect, right? But some people, when you're looking for patterns, it's like there's going to be this secret pattern, and I'm going to find it. And and it's like a mystery, and it's like a search. And once you understand that all of the orders have impact, and it doesn't matter what reason that they're coming out for, that you kind of start to realize that the whole premise, what you were looking for, is kind of dumb. Like, it doesn't really matter so much what people's tendencies are, especially not on a short time frame, because the market just adjusts for that and tries to remove it from the market. But then this guy comes in that is rebalancing his portfolio, and that just results in this huge trend that you can just ride that whole day. All of these other things don't matter. The only thing that matters is predicting that one guy. And that's the sort of stuff that you start to understand Those are the answers that Jean-Philippe gives you, right? Now all of a sudden, why trading is so hard, and yet we can have these strong trends. Those seem contradictory to each other, but once you understand why those things happen, it makes complete sense. It's not a contradiction at all anymore, right? Their markets are extremely efficient on a technical level, like a statistical level, but they're not very efficient from like a price level. So all you got to do, well, not all you got to do, but I think this is, now you're getting into my interpretation of it, right? So what you got to do is look for a fundamental inefficiency out there where something is priced incorrectly, and just wait and be patient for that thing to happen that convinces the market that they're wrong about it, and then just, jump on board. Yes, it really is follow the big money. I kind of hesitate to say yes to that one, because a lot of the technical analysis guys, that's what they say there. They say, like, you go and you're reading the chart and you're seeing that the big money is in there, and which way they're going to go, and you jump on board, right? Well, it's not quite so simple, because especially on a day trading basis, if you see a little trend up, that doesn't mean that it's going to continue, and that doesn't mean that the price that you're going to get is going to be a good risk reward proposition for you, right? So this is the other part. I think that I've realized that because I didn't understand the momentum part, the momentum strategy, why they were looking up all of this stuff in the first place, now I kind of realize a lot of these misconceptions. So I always had a hard time. Well, I still have a hard time convincing people. Like, you talk to the technical analysis traders, and they are so stuck in what they think they know, and it is just like impossible to convince them about anything. And I'm making all of these videos to try and give people the good information that they need to kind of progress beyond that. And especially when I'm, talking about price action and things like that, all I get is skepticism. And it's just like, it makes no sense to me. It's like, why is it that a guy that, has done all of the research, can show you all of the empirical evidence, and has all of these years of, academic research behind it? Not that I spent that much time, but like there's like 30-40 years of academic research to reach these conclusions that I'm trying to teach you guys. And people would rather go and follow some crazy guy on YouTube that claims to have written the algorithm for the market and was visited by the CIA and all of this kinds of crazy stuff, right? Makes no sense. But I think that part of the reason why was because I didn't understand why all of the research, what kind of had prompted them to all of the research in the first place, was the existence of momentum. And momentum exists on a very high time frame, not on a day trading time frame. So once you understand that, and you understand that it's a portfolio strategy, it's not predictive, you have to take every trade and you have to have a large sample size and a good portfolio and everything. Now all of a sudden it's like, now I understand why the retail traders believe so heavily in this thing, but can't seem to pull it off themselves, because they have an understanding from people that were successful with it, did make a ton of money in the 80s, and they're chasing that. And that is the thing that is motivating to them was, well, these turtle traders, they made money from doing it, so I should be able to make money doing it too. It's just that they're not given all of the information. They don't understand the key things that make, since they don't understand the market as a whole, they don't understand the key points that make that strategy work. And so they just fail, right? And then they end up misapplying it and coming up with all of these other crazy ideas off of that are completely incorrect. Now you got the whole picture. It fits together. And I tell you what, it saves you so much time. It saves you so much time, because most of the stuff out there is nonsense, so you can just ignore it. Oh, sorry, I missed Elijah on Aliyev's question, what is your analysis for ZN today? My analysis so far is that the open has been quite lackluster in the treasuries, and that it looks like this market is going to just sit until the CPI tomorrow. I don't foresee any super huge opportunities coming through unless we start to get like big news headlines and something happens in Israel or something like that. But what I'm seeing right now, like, there wasn't a lot of volume on the open. There hasn't been a lot of movement. The level 2 is very quiet. I don't think there's going to be a whole lot of opportunity for us in ZN today. Andre, I'm in rehab. I'm quitting ES after yesterday. Well, FOMC meeting minutes. Do you think that there's going to be something significant in the meeting minutes or not? I'm still a little bit torn. I'm kind of leaning towards, I think that we will be surprised to see what the conversations were under the scenes. Because last time that was kind of what happened. But I'm not actually sure. I don't know. It kind of feels like the Federal Reserve is very much trying to like lead the market here, but then at the same time is like reluctant to say like what they think is happening and what they're doing, you know? I kind of think that the market is trying to front run the Fed, right? The market thinks, oh, they're going to cut rates, and so they want to get ahead of that. And that is kind of counterproductive to Federal Reserve policy. Interest rates have gotten too low. They're too easy. And so the chances of inflation reigniting, I think, are much higher than the market is pricing. So I'm still kind of checking here, make sure that I got my volume levels all right. Basically, yesterday the kids were being really loud, so I put my headphones on, turned on white noise, but then I could still hear it through the microphone, so I had to turn the microphone off. Let's check the FedWatch tool. And now, you know, I have some food here. I'm supposed to be. Maybe I just don't finish it. Let's take a mouthful while I pull up the FedWatch tool. All right, so I almost forgot where we're at right now. 5 1/4 to 5 1/2. The chances that we'll be 5 1/4 to 5 1/2 by December, according to the market, is 2.4%. So it looks like the highest probability is still 3, followed by 2. But very few people think that it will be 1 or 0. And nobody is pricing in a hike. I think that could change, because I think that the more likely scenario is 2. Like, if they don't do it in May and they have to go until August, and I think that when they do one cut, I don't think that it will be like they do one cut and then the next one they'll do another cut and the next one they'll do another cut. I think that they'll do one cut and they'll have to have, you know, a little bit of time to watch and see what happens. So if you don't get the first one until the end of the summer, then the chances of you actually getting 3 are pretty low, I think. Okay, couple of questions to look at here. Scotty Don't P says, if you've looked at it, do you think Norton method red jacket course is worth it? If not, then ignore this. Okay, so I've not taken his red jacket course. He has like his yellow jacket course, the free one, is one that I think everybody should take because it just gives you a really good base of like about futures. This is kind of information that, like, if there was a test that you should have to take and pass before you could trade futures, it would be that, right? So I highly recommend that first one. The other courses, so I haven't taken his other courses, but I am very familiar with what the content was before he like revamped things and turned everything into a more full-fledged course. Before, it was just a PDF. It wasn't that long. It had some very valuable information in it. It was very expensive though, right? So it's especially like his full like top level course is very, very expensive, right? So the question as to whether or not something is worth it is a very difficult question to answer because, we have this idea in our minds that like something is worth a certain value. And if that price is higher than what the value actually is, then I shouldn't pay for it, sort of a thing, right? But what we were just talking about, the whole rant is that entire framework is wrong. I mean, the market tries to fundamentally value things. But the reality is that prices are based on supply and demand. Okay. So Gary is able to charge a very high price because the information that he's providing is extremely rare. Right? So whether or not it's really not about whether it's worth it, right? It's about whether or not you have the demand for it, right? You have enough money to be able to spend on something that expensive, right? And the thing that you got to keep in mind is, okay, will you take this course and then make all of that money back from scalping? Maybe not. I've met a couple of people that have kind of really used Gary's methods and so forth, and I would say that they've been pretty successful with it. I don't know if they made all of the money that they put into the course back, but they're making money, and they've been some of the more successful traders that I've seen, right? But you have to understand that what Gary is teaching is like the hardest way of trading, right? It's really a dying breed, and it is a dying breed for a reason, because the robots really came in and outcompeted the market makers. And he talks about finding a market where you can actually do this, finding a market where it's inefficient enough for you to pull this sort of thing off. So that's really important to keep in mind, right? So if, for instance, I'm just obsessed with market making and I've just got to learn from somebody that was a professional market making, and I have the money, then I'm absolutely going to do it, because I just want to know that information, even if I know that I'm never going to make money from it, right? If though you don't have a ton of money, you really want to trade, but you're not sure where you're going to have the most success, I think that going higher time frame is probably more likely to yield results for you. Okay? Like if you are swing trading, most swing traders do make money, actually. They don't make a very good risk adjusted return. They don't make a very good return compared to if they just put their money in an index fund. But most of them at least make money, as opposed to retail day traders and market makers and scalpers. Most lose money. Right? Okay, so now 4S asks, do you think becoming profitable through tick scalping the bonds and using order flow is realistic for a retail trader? I think that order flow is only part of a complete breakfast. right? You're going to have to understand a bunch of other things too. You're going to have to understand correlated assets. You're going to have predictors of order flow, things like news, understanding end of month flows, options, anything that could potentially predict future orders. You need to have a good risk management strategy. You need to understand volatility, right? So I have a recent video about the key components of a successful strategy, and I've got 5, right? So order flow, volatility, predictors of order flow, risk management, correlations. Probably should say like risk management is the last one, but anyways, out of order. But those 5 things, I think that you really want to understand all of those things. Okay, order flow is important in that framework because order flow is what allows you to see what's actually going on, right? If you're not looking at the book, you don't really truly understand what's going on in your instrument, because you just can't see the individual orders and see that, okay, there's people hitting with really lots of market volume, and there's people absorbing against it really heavily, and you just can't explain everything that goes on without the order flow. So that's why the order flow is so very important. And there are some explicit edges that you can gain just from the order flow. The 2 best examples of those are catching the edge and icebergs. But there's very competitive, it's very competitive edge. Those are edges that exist because of the very structure of the market. So they'll always exist, but you might not necessarily be able to take advantage of it, right? To be able to make money from catching the edge, for instance, you have to be able to actually catch the edge, and most other people will beat you to it a lot of the time. So that's why it's still useful information, right? But it's probably not going to completely do it for you all on its own, right? Especially if you don't understand the news and what's going on in the context of that day, then it's definitely not going to help you, right? Okay. So that's why it's only part of a complete breakfast, right? But to more directly answer Forrest's question, do you think becoming profitable through tick scalping the bonds and using order flow is realistic for a retail trader? The idea that you're going to come in as a retail trader, start with 1 contract, make tons of money just taking 1 tick at a time, and size up to 1,000 contracts or whatever, and be making $1 million a year from doing this, completely unrealistic. Completely unrealistic. Right? If all you're doing is scalping order flow, you should be able to pay for like your data fees and so forth. Keep trading, but I think it's very unrealistic to make a living from it. Hacking is my new trading course to take. Like real hacking is a lifelong course, man. It might be realistic if you're on $1 billion will from the grandparents. Yeah, maybe. It might be realistic if you're a programmer and you're programming high frequency trading robots and you go and pay to have a co-located server. Thank you for the honesty. Well, it's a big deal to me. I appreciate that you appreciate it, though. It's tough because most retail traders lose money doing it, right? For me, I'm happy to just be able to keep trading, right? I had a pretty ugly start of the year. January, like I was doing really great for like a whole year. A whole year, good profits behind me, was making the amount that I wanted to and all of that sort of stuff. I wasn't sizing up. I was still just trading 1 contract, and that's okay because I trade better when it's a small amount, no stress behind it really helps, right? And then January just was awful, just awful. But like, I'm still here. I'm still able to trade. It was not so negative that I couldn't keep going, right? And that's the thing that matters the most to me. It boggles my mind, some of these people that like the risks that they take, because it really does turn into like they can't trade anymore, right? Or they have to start completely back from square one. Can't imagine. AO says minimum contracts you need is 100 contracts. So here's something that the traders at the bank told me. They said that it's a lot easier once you get to the point where one tick equals another contract. So if you're trading the treasuries and let's just kind of, for simplicity's sake, say that the initial margin on another contract is $2,500, right? You come in 15.625, or sorry, 2,500 divided by 15.65, right? 160 contracts. So once you get over 160 contracts, now every tick that it moves up, you could add an additional contract. And they said that once you start to do that the game changes substantially. Because now you can size up as a move goes up, and you will have a substantial impact on that asset too. Or you can quickly get to the point where you have a substantial impact. So, was there anything else we wanted to see with this FedWatch tool? Kind of surprised that they're still pricing mostly at 3 cuts, because I'm thinking too, but whatever. I'll close that down. Wow, I didn't notice the dollar's getting creamed here. Well, it's not that big. It looks big, but that's because the dollar is not moving that much this morning. The treasuries did extend the range, but they're still stuck in the middle. Okay, I'm gonna take another bite of food here. I'm sure there'll be some more questions. Let's see here. I'm currently taking courses through Data Camp. I am in college. Major is data science. Oh, I didn't know that data science was a major now. But I think that data science is a really good field to be in right now. I mean, I wish I understood a lot more about some of the math and statistics behind some of these models. I got a really great book about financial machine learning, and I hardly understand the thing that I'm reading when I read that book. That's one of the ones I'm gonna have to come back to in a little bit. I've been putting a lot of things off because I'm like, I need to work on this video. I've actually got like a number of videos that I need to make, because I wanted to make the momentum strategy one. That one's super important. But I also wanted to make a review of the chair. I mean, I got the chair. I recorded a bunch of footage for it. Like, I do think, excuse me. I do think that that would be a good video for the channel. I should do that. I kind of feel a little bit demotivated. I was editing my my momentum video yesterday, And at the beginning, I was like, I don't know if this one's really going to do it. I don't feel like that the beginning is engaging enough. I feel like it's a little bit cheesy. I don't know if people understand what I'm getting at. They might leave the video too early. But then as I started to go along, I'm like, oh, I like this. I like this part, right? But, you know, it's very easy to get discouraged when you're making content, you know? I got that one. I also have one about the rack mount setup. I've got a setup that we're building out for doing machine learning and so forth. And the whole thing is I really want to spend more time doing that, but I've had a hard time finding the time. I really only get the time on the weekend, and when I've had the weekend, I've been working on the desk and doing woodworking and stuff. So I haven't had the time to really get into the programming of it. I also want to spend more time programming in Rust. I find Rust to be a really interesting language. Have you seen the movie Limitless? I actually, I don't think so. That's the one where like these guys get superpowers, right? That's the one that's kind of like I can't even remember. Akira. It's kind of like Akira, right? Or is that? No, it's not. I don't think I've seen that one. It's another one of those you only use 10% of your brain tropes. Dude takes pills that make him use 100% of his brain. Oh, I got you. Funny. Lucy was better. I found an NV. Wait, what do you mean by an NVR? You're gonna tell me what an NVR is and be like, oh, of course, like, right? Oh, a network video recorder? Well, wait, what would you do with that? The 4 cameras. Yeah. I want to learn Rust, but it's really easy for me to just come in and pick up any odd language, but Rust is not the same. You really have to like learn new patterns and stuff like that. And that's what I'm really interested in about it. So for instance, my experience with Rust was I wanted to make a clock. I still want to do this. I was thinking about this morning. I want to make a clock that I can come in and I can put certain alarms in it, right? So that at like 8 o'clock, there'll be an alarm. And then it will show up at the bottom of the screen. So you'd see something like this where, come on. For some reason, my Epic Pen is not working. I want to draw a picture of it. Let's just close it. Do you think a retail trader has a better chance of being profitable swing? Probably. Being profitable straight up? Yes. Almost certainly. If you come in and you swing trade the S&P 500 or stocks and you mostly buy, you will probably make money. Your return, your Sharpe ratio will probably be awful. Your return relative to if you had just bought and hold the S&P 500 will probably not be as good, but you will probably make money. Okay, I want something that's like down here at the bottom, you know? It'll be like, you know, I'll have maybe it'll have these ticks, right? And then I can have one that's like this event, right? And then it can have the thing, and it can like color it in as we go along the day, so that I have a visual indication on my screen all the time about how close we are to a particular news event. That's what I want to make. And once I started going into Rust, I was like, I thought I knew the syntax and everything, but like the code that I was looking at and it was way more complicated than I thought. It was way more complicated than I thought. And especially when you get into the certain kinds of patterns that you have to use in order to keep certain frameworks and so forth memory safe. You know, I haven't done any study on that at all, and like you really need to understand that to use Rust. So, and I enjoy things that like I actually have to study for it. I've started to find, you know, like in school, that's the way that it is, right? They're all foreign concepts to you. You have to read, you have to take notes, you have to memorize things, you have to do the practice questions so that you're ready for the exam, right? And then you don't really have that for the rest of your life, or most people don't. And then I took the financial exams, and so I completely built up rebuilt my study habits as an older person. And, you know, once I did that, I do kind of feel limitless, you know? Like, I'm just so much more insanely efficient now at things. In terms of like remembering everything that's going on, like understanding my tools and things, memorizing stuff. I love it. And so Rust seems like something that I can really dig into and do that with, you know, and get good at it. I don't know if the one thing kind of holding me back on that one is like, I don't know if it would ever result in better job opportunities or anything like that, but I would think that having an SRE that's well versed in Rust would be extremely rare and valuable, but maybe I'm wrong. You could write that in Bevy. Well, I could probably write it in Python. You go and find the right frameworks to draw transparent objects on the screen. I could probably write that within 10 minutes in Python, but I want to do it in Rust. That's the other thing, is that the most of the programming that I have done has been web programming, a lot of C#, React, Node. You know, there's another thing that I really want to make, which is the rock paper scissors game. So I want to make a mass rock paper scissors game, and what I can do is give you guys the link to the rock paper scissors game, and then we play it in rounds, and it's all of you guys versus me, and there'll be like two rule sets. One rule set, we all have to guess at the same time, and the other rule set, I get to see what you guys picked first, and then I pick. Okay. And in that second scenario is kind of how I view market making. Is like the market maker can just sit and watch and see what everybody else is doing and then adjust to that, and because he's so big. And so because of that, you would think that it's like, you know, it's random. So in rock, paper, scissors, you should win 1/3 of the time. But because I can see all of you, it's going to create a more scattered distribution, right? Some of you there will be like 1 or 2 people that like guessed it correctly every time. And then the majority of people will get lower than 30%, right? That's something that I would probably write in React and Node. Makes me not want to play. Yeah, it does. But that's the way that it works. So I really like the framework provided by the Kyle model, which was kind of like the first study that really kind of started into this market microstructure kind of stuff. And the framework that he used was basically like, there is a market maker, there's an informed trader, and the rest is just noise. And so if I'm a market maker, how can I tell if that informed trader, and this informed trader, he knows that an asset is going to be at a certain price at a certain time, right? So he wants to maximize his profit. What is the optimal number of contracts for him to trade to maximize his profit based on that knowledge? He knows which price it's going to be at a certain time, right? So based on the amount of volume and volatility in that particular asset at that time, what's the optimal number of contracts to trade, right? And then the market maker can kind of look for that and adjust his best bid, best offer based on the probability of there being an informed trader out there trading against him. And so under that framework, there's only two ways to make money. One is to be the market maker, which basically means you have to be at the front of the queue, by the way, right? You have to be at the front of the queue, or you're informed. You know what's going to happen. You have information that the rest of the market doesn't. That doesn't mean that you're insider trading, because there can be information out there that is public and is okay for you to trade off of that can very highly predict what's going to happen. Those like last day of the month, like last Wednesday, really great example of where we were able to predict that they were going to buy the treasuries that day because of end of month rebalancing. I had a very good idea of what was going to happen that day that not everybody in the market did, just because I'm paying more attention to what those end of month flows are going to be. Right? You want to be I think that if you're going to play on an intraday time frame, and like, look, I understand it, because you want to be engaged, you want to be on the front lines, and there's a lot of value in that in and of itself. I really think that sitting here and scalping, like whatever I might lose from scalping, I make from like my larger investments because I'm a more informed investor. Okay. But if you're going to play on that time frame, you've got to be informed. You've got to be informed. And it's so funny because retail traders are looking for every excuse they can to not be informed, which is kind of like, if you don't want to be informed, why would you even bother day trading? Like, the edge for patterns on day trading isn't very good. If you don't want to be informed, you should swing trade. You know? What is being in front of the queue? So like right now, if I put a limit order at 13, then I'm going to be 4,345 in line. Okay. So what would happen if we were to come down here and then they only traded like 500 contracts and then they decided they couldn't get through that price in reverse? Then you don't get filled, right? Now, being that far out, it's kind of a little bit of a silly thing, right? But if I'm just trying to pull a tick out over here, you know, then that sort of stuff starts to really matter. So the way that you get at the front of the queue is basically when it ticks up. So when it ticks up, there will be like 500 contracts there, right? And then if you have a good idea that price is going to hold, then that they're not going to trade back into it, you put your limit order there too. And now you're at the relatively front of the queue. And if they start to trade back into it, you cancel your order immediately. Okay. So robots can get at the front of the queue and can basically be market makers, and they can have orders at every price. But a retail trader, you don't have enough money to put it at every price, and you're not fast enough to get at the front of the queue. And so that kind of market making is not necessarily practical. Now, the Gary Norton side of things, and I can't go into his whole course, okay, but the basic gist of what he's doing is he's saying, well, these robots can only factor in so much, and there are these dynamic changes in the correlated instruments. So I can watch ZN and ZB and ZF and the dollar and the Japanese yen and the S&P 500 to all kind of sort out that, hey, this bid here is too low, relatively speaking. And he has a bunch of different conditions and so forth for you to determine. whether it's worth trying to take advantage of that small mispricing. And the robots can't necessarily see that because they don't know that, like, okay, this is the flow that's dominating things right now. This correlation matters more than this correlation, or that sort of a thing, right? Now, could you do it in ZN? I don't think you probably couldn't do it in ZN. And so Gary will tell you to go and find an instrument that is maybe new and doesn't have a lot of liquidity, and will provide you a place where you can sometimes, you know, put a bid at a price that doesn't make sense, and get lucky that somebody is desperate enough to hit into you, and then you take your little scalp. So the only way is to be informed more than the market. Yeah, we could put it that way. When you say more than the market, it's kind of like, okay. It's difficult to be informed all the time, right? And sometimes you can be informed and, like, the flow that you're looking for just doesn't come because you're wrong, or like some other circumstances happen. So, like, there's kind of this inverse relationship with it, right? If you're doing market making or you're doing a very technical strategy, then what you have is something that is very difficult to do. But if you're able to find an edge like that, it can be extremely reliable. That's why those edges are so valued and so sought after. You go the other direction, which is more about being informed, then the issue that you have there, those edges are abundant. The informational inefficiencies are just literally everywhere. Once you become informed, you'll realize how off the markets really are. They're never anywhere even close to where they really should be if we were like had real true fundamental value. Okay. But those trades aren't as reliable. Like, if you're hitting 50% on trades like that, you're doing really good. Usually you're going to be more like 40% on a trade like that. And that's, I hit somewhere between, so the difference for Seth between profitable and unprofitable is whether I'm hitting 40% or 45%. So, what do you mean by fundamental value? Okay, so it's kind of more of a theoretical thing. But we could come in and we could say something like, okay, so for the treasuries, for instance, okay, based on what the coupon rate of the bond that I'm buying is, and how much time is left in the bond, and what the current value of new bonds are, this bond has like an objective fundamental value to it. That if you buy it now and you hold that bond all the way to fruition, how much money will you make from it? You can objectively calculate that, okay? Now, you also kind of can't objectively calculate it because, like, for instance, you don't know what inflation is going to be. So you don't know, relatively speaking, how much that actually is. Because if you make 2% and then inflation is 2%, then you didn't actually make anything, right? Okay, but if there was a fundamental value to it, right? And you will come in here and you will look at the 10-year treasury and you will find that we are never at that price. Whatever that fundamental price should be, we're never at it. Okay. Now, for stocks, of course, it's a much fuzzier thing, right? There's no way to, like, objectively calculate the value, right? But if there was one, I guarantee you the market would almost never be trading at that price. Because the liquidity needs of the market are just too high relative to the actual liquidity that's out there. These big guys, they have to come in and buy hundreds of thousands of contracts potentially, and that moves the instrument because, you know, the market makers have to adjust for it. That's what I mean by that. Let's see here. I searched YouTube and eventually stumbled upon a discretionary approach to trading. This is what steered me away from researching the things you encourage on your channel. I'm not saying anything against those YouTubers. It's just what I followed, I recently got trading in exchanges as a place to start, and I am sort of starting fresh. Yeah, so the advantage that you're going to get from my channel is that the things that I'm teaching you are based off of empirical data. Like there's 40 years worth of scholastic peer-reviewed research on these matters. And the things that we can prove are quite narrow, but they give us a really great insight into the market, right? And most people, the way that they work is, this is how I was taught that the market works, or how I think the market works. Ergo, it should act like this, and I should be able to do this. And so they use logic to try and reach their conclusions. But the problem is that the premises that they have aren't incorrect, right? But yeah, a discretionary approach to trading has issues, right? Because number one is that a strategy like that is going to have is going to be less reliable in general, anyways, right? And then there's the U factor, right? Like if I'm losing, like I lost money in January, why did I lose money in January? I mean, to some extent, I can blame the market. I can say, well, the market did this and it didn't cooperate with me, right? But at the end of the day, the real reason that I lost money was because I didn't understand that market correctly, right? If I understood that market correctly, I would have been able to have predicted the order flows effectively, and I would have been able to get in front of those and make money, right? So the U factor can be a huge, huge impediment, right? And then what people do is they kind of, this is a fundamental problem with all trading. And the way that most retail traders try to compensate for that is by taking on a lot of risk, right? Well, like there's that U factor, but if my stop is so much larger than my target, the chances of me hitting that target are so high that I do that most of the time, right? And then it seems like they are making money when really there's no edge in what they're doing, and they blow out very quickly. Can you explain the square root law? Sure. Oh, let me take another bite of food here first. Unmute myself there. Okay, square root law is this. Let's say that I am the CEO of a large corporation and I own a ton of stock in that company. And I'm about to retire, so I need to sell my position in the company. I need to sell my ownership of the company, right? Now, I own a lot of shares, so I'm one of the largest holders. If I sell it, the value of that asset is going to go down, right? How much is it going to go down? So we have a formula. The change in price, delta P, is equal to scalar Y, which we can calculate, times the volatility, omega, times the square root of the number of shares that I own. So the number of shares that I'm going to sell is called a meta order, right? Because I'm not going to sell it all at once. I'm going to sell it little bit by little bit over a long period of time. Okay, so we call that Q. That's the number of shares I'm going to sell overall, over V, which is the amount of volume in the time period that I'm selling. Okay. So I can come in and I can say, okay, the average volatility of this instrument is this, and the average volume of the instrument is this. Here's the number of shares that I'm going to trade, right? I can go in and I can execute that trade against the market and see how far it moved things and then calculate my Y. Or I can go to Goldman or JP Morgan or whatever, and they have like a big database of all of the meta orders that they've ever executed and how much it moved things to calculate a more accurate Y value from that. Okay. So if I'm going to sell, 10,000 shares or whatever the amount is, right? But I don't want to do it. I'm going to go to the Goldman block trading desk and I'm going to say, okay, I want to execute this. How can I do it? They say, okay, well, you sell the shares to us and then we'll turn around and sell them at the market, right? And so what they do is they say, okay, this is the volatility. This is the volume. This is the Y that we have in our database. This is the number of shares that he wants to buy or sell. This is how much it's going to move the price, right? It's going to cause the price to decline by like $10 a share. Okay. So if he has to sell it to us for a discount of $15 a share, so I can basically, I'm buying it for $5 less than what I calculate I can sell it for, right? Then they get to pocket that $5 difference. Okay. Right. That makes sense. So they're going to say, the stock is going to do this, right? But and then when you're done, it's gonna flatten out, right? But I was able to buy it from them for this, right? Now, if he had executed it, it might have been worse. It might have been like, it might have gone like this, and so it's better for him to execute it through the block traders, okay? So it's a square root law. There's a square root here. What does that mean? That means if I go in and I say, I'm going to do 2Q. So let's say, for instance, that I am going to sell. My gosh, my handwriting is. I haven't used this pad for a while, so my handwriting is a little off. Okay, so let's say that we got this Y omega times the square root of. And let's say that the amount that I'm going to sell is 1% of the total volume for the day, okay? So I'm going to do 0.1 V over V, right? Well, then these two V's cancel each other out, right? And it's the square root of 0.1. Do you know what the square root of 0.1 is? Or sorry, 0.01. I said 1%, right? You know what the square root of 0.1 is? So the weird thing about square roots and decimals is that it makes it go to 0.1, right? The square root of 0.01 equals 0.1. Okay? So trading 1% of the volume can be responsible for 10% of the volatility. Isn't that interesting? Now, what if we traded 2%? Okay. What's the square root of 0.02? Do you know? Anybody? I feel like the guy in Ferris Bueller. Anybody? Let's pull up a calculator. Okay. Square root of, or actually we do it this way, huh? We'd go 0.02 square root. Oh, wait a second. We doubled the amount of volume that we were trading. See, for it says 20%. You would think, right? You would think. But but here's what the calculator says, right? So 1% equals 10% volatility. 2% equals 14.1421356237 blah 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 blah. This is why my favorite number is the square root of 2. My favorite number is the square root of 2. It's an irrational number, but you would think that it would be double, but it's not. It's not quite double. Okay, so let's graph that. Now you're kind of thinking back to your like junior high days, or maybe this was more like sixth grade when they start talking about square roots and stuff, right? So at first you think that it's linear, but then you kind of find that it's not linear, and there's kind of like an upper bound to it, right? A square root law. So this is significant because think about, what if it was linear? What if, me trading 100,000 contracts moved things so yay much, so trading 200,000 contracts would move it twice as much, right? Well then, like, that would be a huge advantage to me, right? The bigger that I am, the more it matters, right? But what this is saying is that, like, yes, size does matter, but as you size up, you get diminishing returns from it, right? The impact that you get per contract decreases as you size up. Curious, right? So it's almost like a speed limit in the markets. This square root law. It's very, very interesting. Now, this results in there's a lot of strategies and market behaviors that kind of stem from this, that they use to take advantage of this behavior. Okay, the most famous one being Almgren Chris. So what Almgren Chris is they've said, okay, I need to buy or sell X contracts. How do I actually do that? Because if I just hit the market with them all at once, that's not going to work. And so Almgren Chris was a way of taking a bunch of different pieces of information that we know about the market in order to create a optimal schedule. To say, and usually the way that it works is like this: is you come in and you sell like half of it at the very beginning, then you wait 45 minutes and you sell a quarter of it, and then you wait 45 minutes and you do an eighth, and then by that point you're usually done, and then the rest of it just gets traded out, right? And so you do this sort of a thing. Right? If you're willing to take on risk, the schedule that it can give you can actually be the opposite, and it'll say only do this little bit, and then this bit, and then this bit, and then at the very end you do this really big one, and everybody's like, oh my gosh, something's going on, and then by the time that they realize that anything's going on, like you're already out, right? And that's the way for you to maximize your money, but it's more risky. Okay. But the key thing here is that they're realizing that they execute better if they just take into account the liquidity. Because if I come in and I just sell everything through here, there's not going to be any liquidity that disrupts the instrument too much. So instead, I want to pace myself so that I never disrupt the liquidity in the market too much. And what they do is they'll trade it, right? Until that square root law impact starts to happen, right? Then they can back off. Back off. The price will come back a little bit like this. This is called the post meta order mean reversion time period. It follows a 3/5 or a 2/5 law. Okay. Actually, it's not a 2/5, it's a 3/5. Anyways, once you do all of the math, basically what it comes out to is that this time period right here ends up being 2.5 times this period. If this is X, the time is X, this tends to be 2.5X. But rule of thumb, 45 minutes. Okay. If you get a move and you feel like you missed the move and now it's like died down, but you think that it's going to keep going, wait 45 minutes. And then maybe you'll see the second leg. Okay. During this time period, they can actually execute a lot. So they actually end up executing more volume in this area than they do this area. And the way that that ends up looking on a volume profile is like, I'll draw it over here, right? There'll be a big spike right here in the mean reversion period, right? Because more volume ends up trading here simply because it sits here for so long. In other words, they intentionally create this liquidity hole because they are able to execute more volume within that liquidity hole. That's why markets tend to do this. Zoop. Zoop. Second leg, third leg. Usually by the third leg, they're done. Right? That's what do they call that? Not Wyckoff. Elliott wave theory, right? That's where that's why Elliott wave theory is a thing. Of course, it's kind of there's some like Elliott wave theory kind of he was just looking at what he could see. You don't understand why it was happening. Once you understand why it's happening, you kind of understand why like expecting it to always be 3 is kind of silly. Maybe sometimes they only need one leg and they're done, Right? So how is volatility typically measured for things like this? So you could just go in. Let's try and do this. Let's try and do a practical example. Okay. And let's see if I can still find the information. Is there an area that you believe has the most potential for a retail trader? Maybe a strategy of analyst instrument, or where would you? Well, I think that the place that has the most potential for a retail trader is if you're really informed, right? If you can be informed all the time, well, so as an example, congressmen tend to make really good money from the market, right? Because they're informed. They get access to information from their congressional hearings and everything that allows them to make good calls. Of course, they get access to information that we would typically not have access to, but I digress, right? The best thing is being informed. If you're not informed, just put it in an index fund, right? Let's see here. I've done this before when Elon Musk sold his shares in Tesla. But it might be hard to find that data again. So let's see here. The one that I'm seeing right now, they're saying 2022. So this report was December 14th, 2022. Okay. So let's look at this day right here. So I can come in and I can add some indicators, right? I can do average true range, right? And I can do volume. And I think that volume may include a moving average as well. volume moving average. So let's use, for our length, let's use a 30-day moving average. And we'll do the same here for the ATR. Make it a 30-day average of volatility. Okay. So on this day right here on the 22nd, okay, the ATR was about 11.8. Okay. So omega equals, excuse me, 11.8 dollars. Okay. And the average volume is 107 million. 107 x 10 to the 6th equals V. Okay. And Elon Musk is going to sell 22 million shares. Okay. So we don't know what Y is, but let's just guess that it's 1. Okay. 1 times 11.8 times the square root of 22 divided by 107. Right, because this is a million, this is a million, the millions cancel out. Okay. So 22 divided by 107 equals 0.205607. Okay, and then we're going to take the square root of that. And then we're going to times that by 11.8. 0.05. Wait, am I getting that right? Let me see here. Yes, I think so. I'm just going to go and calculate them all again, just to be sure. That by 107. And take the square root of that. So they're saying that I should move it 5 cents more. That's not right. Because they moved from 173 to 160. $10. Maybe times, maybe Y is 2. Then it would be 10 cents. Well, okay. When I did this before, man, so remember when Elon Musk is like, do you guys want me to sell? I guess I'll sell like 10% of my shares or something like that. I think that was at the end of 2021, wasn't it? No, it was around here. It was like somewhere around here, right? It looks like it's dividing 107 twice. Let me try it again. Okay, so 0.2056, 0.2056 square root equals 0.4534. That is more like what I was expecting to see. Times 11.85. Okay. So, it normally moves 11.8. I'm going to get 5. Okay, so then we'll add 11.8, like the average volatility to it. And you're going to get 17. And when we come over onto this day in December of 2022, and how much did it move? It moved from about 174 to 158. So it moved about 10 $10. No, wait. We'll just do a 174 would be exact for right here. It'll tell me the high. So what was the high? 175. And the low was 156. 19. So I said that it would be about 17, and it was 19. So probably Y is something like 1.2, something like that, right? So I kind of stumbled through that a little bit, but I hope that makes sense as to like how a professional would approach using the square root law, right? So now I could come in and I could say, okay, Mr. Musk, we will execute this order for us, but you have to sell it to us for $155 so that we can make $5 a share on it. And he goes, okay, because if I executed it myself, it would probably decline like $30. And so then I would, make even less. Right? That's how this square root law works. Now, let me show you one last thing. And this is kind of where it becomes really relevant for trading. Okay. Close this. Your impact tends to be like this, right? Okay. Why is that? Well, it's because you create a liquidity hole behind you. So when you stop, you tend to get this thing right here, right? This post-meta order mean reversion. Because basically, you're leaving a wake behind you, and so when you stop, you kind of get sucked into that wake. Right? Well, what would happen if I tried to buy even more right here at this point, right? It wouldn't go like this, right? It would just add on to that meta order. It would just continue to go sideways, right? Okay. What if right here at this point, somebody came in and sold it the opposite direction, right? Like what if I came into the market and I bought 10,000 contracts and then I sold 10,000 contracts, right? You would think, yeah, if I can move the market by buying it, I could make money off of that, right? I could make money off of my impact alone. Okay. But what happens is because there's this wake behind you, if you buy 10,000 shares and then you sell 10,000 shares, it does this. And you will actually net lose money like that, right? Let me draw that again. You do this, and then it's going to go like this, right? And you will lose this amount. Loss. Okay. Remember that. Next time people talk about how they manipulate the market to screw you over and yada, 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 like they're buying it up just so that they can sell it against you and that sort of a thing. Well, I mean, kind of like you can't make money from your impact alone because of the square root law and why the square root law happens. Now, something that I could do. Octavius is long here. Okay. I'm not going to take a trade today. If I wanted to sell it and I really wanted to give myself like the best chance of it moving and like people taking note and thinking that momentum is coming in and stuff like that, I could come in and buy a little bit first and then come in and sell twice as much, right? To get myself short. And that will, that will disrupt the market and move the market more. So that's one trick that they have that they can play on us. Buy it a little bit first and then move it the other way. I'd say this is a relatively rare trade because there is a lot of risk involved in doing this, but it does happen. You will see it. Make sense? Watch for it. You have a day where they're buying really strongly for whatever reason it is. And then some like really scary news headline comes out that causes those guys to completely puke their positions. Those are the best trades because what's going to happen? They're going to go lower. And everybody will come in and say, oh, well, it's going to come right here and then it's going to bounce. It goes through. It tends to go through. So there's like an actual pattern edge, I guess, that you could potentially use. Of course, it still requires some context about why did they sell here and how many orders are going to sell. Is the number of orders they're going to sell here going to actually be as much or more than this rise? Okay. Are you starting to see why the square root law can be beneficial to your day trading? Or the bigger thing, and kind of why I'm doing what I'm doing today, is like, again, if we have a trend, if we have a large meta order, right, they're going to reach the impact of that order, and then there's going to be this mean reversion period, right? Okay. If I get here, I don't want to get in, because what's going to happen? It's going to come back, and then it's going to sit there forever, right? And so what happens? You think the trend's going to continue, you buy in, it goes 4 ticks against you, and then you sit for 45 minutes hoping it's going to come back. It doesn't, and you give up on it and you puke. And then as soon as you puke, goes again, right? You ever had that happen to you? Okay, well, now that you know what the square root law is and how that affects the way that these large players execute their orders, now you can go and you can say, hey, I'm seeing signs of the liquidity hole being formed here. This is a bad spot to get in. I should wait. If I really, really want to take another trade, I should wait 45 minutes. And I can't, it's not like an explicit edge, because it's like, it's not that you make money from it, right? You maybe lose less with it, right? But oh my gosh, the benefit that it will have to your trading is just tremendous. I can't tell you, especially to your psychology, how much it helps to not have to sit in those trades that just sit in the doldrums forever. This being stuck in this is so frustrating. You don't want that. Avoid that. Yeah, hopefully not in ES. Now, ES is maybe a little bit of a different beast, because there's so much randomness in ES that, but it still does the thing, right? Because what they will tell you is it's a flag, right? The technical analysis traders will tell you it's flags, right? If there's a pattern that has like legitimate value in markets, it's this flagging pattern. 1, 2, 3. Okay. It's just that the problem with it is that you usually don't realize what's going on until you're like here, right? The majority of people will realize something's going on right here, and then you're stuck in this. And you don't know if there's going to be a second leg. You can't really predict there's going to be a second leg unless you have some idea about how much volume is coming in based on this order flow, whatever it is. So that's why I always say, like, the pattern is the result, not the, right? Like, I don't want to see this and then buy it. I want to buy it and then see this, right? I'm happy to announce that I feel no withdrawal yet from the ES. UB and ZN has been doing a good job in exchange. So you know what happens to people? This is what people do. You meet some girl, you know, you're between the ages of 16 and 30, I'd say. And you come across some girl, and this girl just seems perfect. It's just like they fit all of your boxes, all of the things that you think you're going to look for. You have similar interests, and everything just seems absolutely perfect, right? And then you like start going for it, and you know, there's like roadblock. They're not sure. You have difficulty getting things set up, etc., etc., etc. Right? Okay. Run. When this happens, run. Okay. When you see somebody, they just seem so perfect. That's a lie. That is you're lying to yourself. You are not seeing the situation very well, because nobody is such a perfect match. Okay. It's just not actually a thing. Okay. That is a sign that you are in a bad state. You're not seeing this correctly, right? And you will tend to feel this with people that cannot actually give you what you want, right? So then you do this back and forth. Have you ever done this where you sit and you think about the girl and you want it to happen, and there's like some event, or like, you know, you're supposed to call them tomorrow, or like you talked to them yesterday, so you want to wait 3 or 4 days before you talk to them again, or something like that, right? And so the whole time you're sitting and you're thinking about it, you get butterflies in your stomach, etc., 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 and it's like you're in love, right? No, you're not in love. That's anxiety. Okay, love is not anxiety. What will happen to you someday is you will find somebody that may seem completely boring to you. It's just like, well, but you know, they don't have this thing and that thing. They're not really all that special, right? But they're there, they're around, and you get along, and it just kind of becomes its own self-perpetuating thing until all of a sudden you realize that you're in the most secure relationship that you could ever possibly be in, even though you didn't think that you were actively seeking it, and you didn't think that it was going to happen, and you kind of dismissed that person at first, right? And once you realize that you're in that situation, you will never want to go back to that person that made you feel anxious all the time. You realize that really was not love. That was anxiety. What I have now is secure relationship, peace. That's true love. Okay. That's what ZN is like. That's what going from ES to ZN is like, right? Or especially if you're going from like NQ or oil to ZN, right? ZN is stable. It's not exciting. You know, you dismiss her at first, but as time goes by, it's reliable. It just works, and you can't help it. You fall in love with ZN. That's how it happens, friends. That's how it happened for me. It'll happen to you too. If you're so lucky, it will happen to you too. Some people, they just get stuck in that cycle of the anxiety every time, and they go after the wrong person every time, and that's why there's so much divorce, but I digress. Don't put up with that stuff. Similarly, here's another thing. You go to a job, and you know, like there's somebody on the team that you don't like. You don't think that your boss likes you. You don't like the strategic decisions. You think that the company is making dumb strategic decisions. Those sorts of things, right? And what do most people do? Well, it's my job. You stick with it forever and ever and ever, right? If I stay long enough, maybe they will promote me. No, the companies these days, they never do that. They never promote you. There is something, you know, I stayed at companies for a long time, and it totally benefited me, but I understand why most people hop around, right? Because they don't. You almost never get the promotion, right? But when you switch, as long as it's not a recession in your industry like it is right now in computer science, excuse me. Computer science is in a recession right now, but otherwise, I think you'll find there are so many other opportunities out there that you don't have to put up with BS. You don't have to. There's something that you don't like, just move. Just change. You have to adopt the mindset of abundance. I don't have to get this one girl to fall in love with me. I know it seems like I don't have a lot of opportunities and so forth, but especially your guy, trust me, you get older, it'll happen. Happened to me, it'll happen to you. As you get older, they come out of the woodwork. You realize how many opportunities there actually are. And then it's kind of like, oh, well, what's the difference between this one and this one? Does it really actually matter? When there's like literally millions of people that you could potentially match with? Are you really going to be that picky about it? I don't know. For some people, I feel like that kind of ruins the illusion of life, but I find it liberating. This is the best live stream. Oh, thank you so much, Forrest. I'm so glad that you're enjoying it. But so, you know what though? Let me tell you something, Forrest. It's not me. It's not me. Most people, when they come into this stream and for the first time and they ask me questions and things like that, you know, because what you're getting is a direct consequence of the questions that you asked me. You just, for whatever reason, asked the right questions to get all of the best content. Because this is stuff that like we talk about almost every day. I don't know. It's been a while since we've drawn the pictures of it, but you can go back on live streams and find countless live streams. I'm sure that they could turn me into a chat GPT, and that chat GPT would be extremely accurate to what I would say during a live stream, right? Probably should be pretty easy to do that because you can get transcripts of all of the live streams. Like YouTube already makes those, so we just gotta use the API, pull the transcripts out, put them into ChatGPT, and then you can get speculator Seth GPT, right? Should be easy, right? But you are asking all of the right questions, and that's why you're getting such good content, man. Do you have a video that helps you into trading the tenure? I've been trading it, but I've not been finding good entries and exits. So I think I do. Let's see here. What would be the best ones to look at for that? YouTube.com/speculatorseth. Okay, so first of all of these sorts of things like improving a volume profile, day trading strategy, these are all useful things. Okay. This one, how to trade Federal Reserve policy. I felt one of the best videos on the channel. I find it incredibly ironic that one has 589 views compared to some of these other ones that have thousands of views, right? Because this is one of the most valuable videos on my channel, how to trade the Federal Reserve. 5 reasons to trade micro yield futures. I go into some of the things about trading the treasuries in that as well. So those, as of recent, are probably the 2 best ones to kind of helping you trade the treasuries. Okay. I think that if we go further back, there's the order flow video series. That's really, really valuable. That's the best content on it. This one, I'm so glad that one has 45,000 views. This one, like, developing a strategy, that's kind of more if you're gonna do programming, right? I feel like there was some earlier ones. Maybe not. Yeah, maybe not. Some of the earlier ones were more about the politics, which I find kind of ironic. These ones should really actually be live streams. Can you believe some of these 6 years ago? Wow. Wow. Okay, so that's the start with videos, okay? Granted, I have made more in the 10-year. Just not that many trades. Okay, so now let's kind of go back with all of the things that we know, okay? The treasuries have extremely high liquidity. They are the most liquid instrument in the world. So they have the most consistent flows as well, right? Like there are people, their pension funds or whatever, and they have to buy a certain amount of treasuries each month, and there are ways that they do that. Okay, so these flows are really strong. So that's the first thing, is that in the 10-year treasury, the end of the month, the end of a futures contract, and the end of a quarter in particular is really big, and auction days when new supply demand comes into the market. Okay, those are extremely important to the treasuries. More so, I think, than like any of these sort of reports are to the S&P 500. There's really not anything comparable. Like the end of month flows in the S&P 500 are not nearly as reliable or strong as the end of month flows are in the 10-year treasury. Okay, so just think of it from that perspective, right? Like higher liquidity means more stronger predictive signals. Okay, so those kind of predictive flows are more influential. So that's the first thing that you kind of want to keep in mind. Okay. The next thing is that the treasuries are extremely economically sensitive. So CPI and non-farms are the most are like big moving events for treasuries. Okay, CPI in particular. It used to be that the market, like the S&P 500 would completely ignore CPI, but never the treasuries, right? And then PMIs. PMIs are the next big one because that's like the most leading indicator that we got. Okay, so that news really matters, and the treasuries will move based off of, those numbers a lot, and or not move. Like we have CPI tomorrow. That's why it's not moving a whole lot today. The next thing would be, and this is a flow that we do not get very good observability into, unfortunately, as retail traders. There is data out there, but it's like, it's professional data. It's hard to get access to. Okay, but something that can affect flows would be flows from competing instruments, right? So for treasuries, the biggest competition that the treasuries have are corporate bonds. So knowing how much corporate bond issuance is coming out that day or whatever is kind of a big deal. I don't know how you get access to that information. I don't know if those guys, they don't find out until like just before it happens or what the deal is. But we have had some situations where like, Amazon or Apple just come in and just do this absolutely massive issuance, and you get like a full 5 basis point move in the treasuries as a result. That's happened 2 or 3 times, but that is another flow that you kind of want to pay attention to. Okay. The next thing is on the order flow part, so kind of more tactical. Okay. All of these behaviors that we've talked about today are just so much stronger and more apparent in the treasury. Okay. So explain this to me. I'm coming over here into the treasury. Okay. Trend. Right? It goes up. What? 1, 2, 3, 4, 5, 6, 7. 7 ticks. Almost 8 ticks. Almost 8 ticks. Right? That's a good trend. That's good money in the treasury. That's $125 a contract. Right? What's this? How can they go up 8 ticks and then just immediately stop and go nowhere? How is that possible? Right? And then it seemed just crazy that the treasury can have like this huge trend and then just go literally sideways. For how long is this? This is from 720 to 7. Oh, what do you know? It's almost 45 minutes. You can smell what I'm stepping in here, right? This is that square root. Often in the treasury, you don't get like a full comeback. If we were having like a 32 tick trend, then it would probably come back like 46 ticks, and then that would be the mean reversion period. Okay, but this is the liquidity hole. This is the post meta order mean reversion period. So if you're right here and you missed this, you start to see this form. You don't want to take that trade, right? Avoid this. Avoid this. If you know what's going to happen and you can get filled at the bottom, you know that there's going to be another leg, then at the very least get filled below the center of that range, okay? At the very least. Don't be the guy that's like buying it right here, right? You wait for the breakout, it breaks out by 1 tick, and oh, what do you know? It only goes like 2 ticks and then comes back, and now you're stuck in another liquidity hole, right? Because that maybe there was another meta order, but it wasn't very much, right? You see it right here? Like here's the first meta order. Here's the second one. They were kind of quick trades too this time, which is interesting, but okay. So that's like, how do you tactically place yourself, right? Well, you can kind of use those liquidity holes to kind of help you judge where you want to get in and like what is the best way to do it, right? If I am gonna take something like this, like on a breakout, like I really end up chasing it. Sometimes it works out. If I really know that flow is coming, then it can still work out. Okay, I'm gonna be taking it as she goes, right? I'm gonna be coming over here, looking at the DOM, and saying, I want that 3556 to be 500, and then hit into it. And as soon as I hit into it, it ticks up, and then there's 500 behind me, right? And then that 500 easily stacks to 2,000, 3,000, and now I know I caught the edge. If I absolutely have to, I could sell into that and break even, right? Tactically. Or vice versa. If I know there's a liquidity hole at so right now it's rotating around 18.5, right? So I could be sitting here with a limit order at 18 or 17.5. But what I could also do is wait and see, like if we get down to 17.5 and I see iceberging, right? That would be, of course, I have to know what the flows are going to be. I have to have something that has a really good job of predicting that ultimately in the long run we're going to go higher. Okay, but if I have that, tactically, getting a fill on an iceberg down here in this area would be really advantageous, right? It's crazy how you have all this info. Well, not really. Like realize that coming in and saying all of this stuff every day for 6 years, it's not really at that point even memorized, right? It's just a part of you. Yeah, I probably could clip. I really need to get, I wish that I could pay somebody to be a video editor and they could edit clips and turn some of these things into videos, but oh well. Obsidian, how you been? By the way, while I'm thinking about it, I forget, Octavius took a trade and what price did he take? Because I was being like, oh, don't be the guy that bought it here, but then I was like, wait, is that where, that wasn't Octavius, was it? I think he might have deleted the post where he said that. Oh, no, he's long. It doesn't give me the timestamp, so I don't know what price it was. Oh well. Anyways. Okay, so what else? Okay, the biggest thing that I look for is I want to see this correlation in cumulative delta, right? So this isn't a very good example because this is pretty messy, okay? But like, autocorrelation is basically a measure of like how much does a data series past predict its future, essentially, right? How much does it predict itself, okay? So if you have a chart like this, let's just say that this is the whole chart, okay? And the line is like this, okay? Then that is a autocorrelation of 1. Okay? If we have a chart, this is the full period, because you know you can give it a time period and you can say, okay, over an hour period. Okay. So if over the hour period it does this, and then it comes all the way back down 0. Okay. Oh, he said 18. Okay, that's not terrible. This has an autocorrelation of 0, right? Okay. This would also have an autocorrelation of 0. Okay. So generally speaking, if you have an autocorrelation of 0.8, that's really high. That is, you just had a really strong, long trend. Okay. Today, it's maybe more like a 0.5, 0.4. I'm not going to put the indicator on here, but you can just kind of tell, right? The more that the cumulative delta is just like a consistent straight line, better it is. Now, do you notice, by the way, like look at right here. Here, they sold. There was a decent decline there, but did the treasuries sell? No, they didn't. Okay, so here, cumulative delta and price diverged. I continue to see buying. So that means that, you know, when we saw this big order right here, for instance, probably could have bought it. Probably could have bought it at 16. I'm not going to take a trade today because, you know, I don't think they're going to do anything for CPI. I don't have a flow that tells me that it's going to be long, but you can see that the flows were long. So we could have taken a trade based on purely the technicals. Or, I mean, if you were going to take a trade purely on the technicals, you would have gotten a signal there. We put it that way, right? Okay. That's what I want. I want to see autocorrelated order flow in all of the instruments, okay? When you're getting that, almost doesn't matter which price you catch because the treasuries, they tend to trend, right? Like this move up to here, you got 11 ticks without it coming back even more than 3. Because it'll draw a new pivot if it's 4. Okay, so you didn't have a pullback of more than 3. So it almost doesn't matter which price you catch, right? If your stop was 4 ticks, you could have bought anywhere within that trend and made money. Unless it was like right here and you're still stuck in it and hoping that it continues to go up. Okay, so those are all kind of the things from like a tactical perspective that I'm going to look at to try and help optimize my entries. What valuation model can you use for crude oil? Oh, I wish I knew. Okay, so here's what I do know. Is that the way that these guys go and look at it is they say, okay, here are all of the things that happen that affect supply and demand in oil. So like there's an EIA oil report, right? And they make this spreadsheet and they have all of the dates on it. And they say, okay, here is the oil report. Here is this report. And there's a couple of them every week, right? This is what they do at these commodity hunts. Yep, rig counts, oil supply stocks and oil demand, like on Wednesday at 10:30 Eastern time, right? Okay. You put all of those things in the spreadsheet, and then you go in and you say, this is what I think those numbers are going to be. How they calculate those things, I don't know, but they have some sort of idea. They have this, like, they know how many oil rigs are out there, last report, and you know, they can kind of guess based on certain information what they think it's going to be. Okay. And then they kind of build this model out where they say, okay, here's the supply and demand. And so that's how that will affect the price. And that's how those big commodity houses tend to trade things like oil and gold and so forth. Yeah, OPEC, MOMR, they use satellite images. There you go. Yeah. So they might have a piece of information that tells them, oh, this company is doing better, or like some process is like working really well. And that means that there's going to be more supply because of this, and yada, yada. Or this country is doing better than expected, and so that's going to mean that the overall demand is going to be higher than in this way, right? And by doing it all in a spreadsheet, they can make a fairly accurate calculation about how these things are going to change. And then when the number actually comes out, they go and they put that in the spreadsheet and they recalculate everything, right? In commodities, there's no law to prohibit insider. Well, kind of. So in the futures, what they mean, the reason that people say that is like, if I'm producing oil, right? I know something about how much oil I've produced. I know something about how much I'm selling or how much people want to sell, right? So technically, I have insider information. It's not, I wouldn't call it insider trading, because it's like, insider trading is about a very specific type of data that belongs to the company and that you're not supposed to trade on. And you don't want to trade it because it's a conflict of interest, right? But in commodities, if you came in and you said, oh, not everybody has access to that information, you can't trade on it, then hedgers just wouldn't be able to participate in the market, right? And that's the entire reason that the market exists, is so that the hedgers can come in and hedge their positions, right? So that's why they will say, you know, in commodities, there's no law to prohibit insider trading. Well, yeah, okay. The people that produce it probably know things about it that you don't. But that's where it's like, okay, like the guys at Cargill, they know a thing or two about what the supply and demand and that in that market is. How they get that information, I don't know. I think my understanding is, to some extent, is that they talk to people. You know, they have friends at different companies and they call them and ask them about how their business is doing and all of this sort of stuff. And they use that to, you know, for part of their trades. Okay, when will your video on momentum be released? Hopefully on Monday. I think I'm on track to do it on Monday. I recorded it last week. I'm editing it right now. The key takeaways, if you want to know already, is that momentum is a strategy that works, but it requires a large amount of capital to deploy successfully. It's a portfolio strategy where you're going to be buying and selling in multiple different instruments, and it's not predictive. It gets you in at the beginning of a trend, and you have to take every trade for it to work. And there's still a high amount of risk involved. You can get a good Sharpe ratio, but the amount of risk that you're taking on is higher than if you just invested in the S&P 500. And so these are all kind of caveats to the momentum strategy that retail traders don't understand. And so they're watching momentum traders and trying to apply all of the lessons and pieces of advice that momentum traders give you, and then try and apply momentum to a 5-minute chart, and it doesn't work. When really what they should be doing is they should be looking at a daily chart and saying, okay, is this stock in momentum? Not on a daily basis. Not looking at this chart. I'm looking at this chart. And when I get into this chart, then I can say, well, we are breaking out to new, 3-month lows. And the 50-day moving average is below the 100-day moving average. So I guess we are in momentum short. And so that's the flow that we have to think about. That just reminds me that I didn't remember to come in and do any of this stuff today. 6th and 9th today, right? I'm getting better at that. This one is like the only flows that I have for today is slow flows waiting for CPI. It's the only like super significant one that I have on here. Discussion. Discuss square root law. Tactical trading in ZN. What did we talk about before that? Anyways, the point of the momentum video, the reason I'm excited. Oh, I didn't switch it back over to here, so you didn't even see me write all that stuff. The reason I'm excited about the momentum video is because I'm hoping that some people will realize that all of this stuff that they've been looking at as a retail trader was kind of based on a misunderstanding of somebody else's success, right? They were excited because of these technical analysis traders. Oh, I didn't realize that they were swing trading. If I actually want to do what they were doing, I should be swing trading, right? That's basically the point of that video. What's the dollar doing here? Oh, dollar's got a very clear inverse head and shoulders going on. You think it's going to come out? Well, I guess it's already too late. Because you could potentially say that it should come all the way back up to there, but not that I would trade head and shoulders patterns. But it's interesting to note when it does happen. So let's see here. I haven't even, we've had so much discussion. This has been a fast session. We only got 30 minutes left. But let me come over and make sure I got everything on social media and so forth, if there's any interesting information. Leah Bengali decomposes inflation into interest rate responsive and unresponsive category. Or rather, whether each inflation category has historically declined after a surprise interest rate hike. Current excess inflation is entirely due to the unresponsive categories. Oh, that's interesting. That's interesting. So, like half of it is from unresponsive. So, increasing interest rates only solves about half of the problem. That is really, really interesting. I wonder what the implications of that are. Would you say a good swing trading strategy should have some sort of fundamental reasoning in addition to any technical? I would say that if you have a good fundamental understanding of things, that it can definitely help your swing strategy. But that's the big thing that you got to understand about the swing strategies is that you can't necessarily particularize the general, right? So what people want to do is they say, when we see this pattern, they tend to move up. And when we see this pattern, they tend to move down. And when we see this candlestick, we tend to do this, and yada, 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 yada. And so then they say, okay, here are all of the different things that apply to this particular situation. And then they're going to use their discretion to determine which ones of those things matter more to them at that particular point in time to determine whether the stock is going to go up or down. And that's just nonsense. It's just a complete misapplication of the statistics, right? Like, you will not realize the results of the statistics unless you take all of the trades. You're picking and choosing. You won't realize that statistical aberration or whatever. Okay, so there are swing trading strategies that are based on that, but in order for them to work, they have to have a large portfolio with a bunch of different instruments that they're trading, and they have to take every signal. For you as a retail trader, that might not be practical. You might just come in and you might just be swing trading the S&P 500 or the treasuries, right? And in that situation, I can certainly use technical information, right? But I would much rather, have a good inkling about why. Like if I'm in oil, right? I would much rather have some idea about why is oil, bottoming here, and this is a good time to buy and bring it up so that by the time that it gets into momentum, I'm already in. That would be the optimal thing, right? And if I really understand that instrument and I'm actually doing a good job, you would think that you would know that that's happening. Maybe you wouldn't. I don't know. But trading is hard. Even swing trading is hard, right? I mean, this is the bigger thing. The first question that you got to ask yourself is, why do I want to trade? Right? If the reason that you want to trade is because you want to have more money and you want to be more free, then don't trade. Because it is anything but that. Making a living off of trading is stressful. Making a living off of trading means you're going to want to stay home and watch the news all the time. It means you're going to be sitting in a chair a lot. It's just not all that, right? If you are looking to free yourself, I would look elsewhere. There's lots of different things that can potentially provide that might be a better match for you. But if the reason that you want to trade is that you just find the market incredibly fascinating and you're just obsessed with it and you would watch it regardless of whether or not you make money, that's a different thing, right? Now you stand a chance. Octavia's out +4. Not bad. For today, for a day like today, that's really good, in fact, isn't it? I think I would say also that we have had a little bit more upside today than I would have thought. I'm not quite sure what prices we would need to get to before I would be like, okay, this is a little crazy and all that, but there's definitely the 16. You get single prints all the way up to 109.30, so I can't see that happening today, but, it is there. 24 is still there, so maybe 24. I guess I like the mystery / the research. It feels like one big puzzle. Well, then pace yourself. Because right now you're like drinking from a fire hose from coming out of me, right? That probably gave like a bad mental picture. Forget that I said that. Oh yeah, so next thing was to go to Zero Hedge and see what I get. Lori Lightfoot lands $400 an hour job investigating worst mayor in America. What the F? Okay. Margin debt surges as bulls leverage bets. That's never a good sign. Stocks face rug pull from extreme momentum move, probably. But not a whole lot of stories here. There's a bit more. So when I come back onto the treasury and I look at, oh yeah, it's there. It's there. So, I mean, we've kind of had gentle buying this whole time. Again, I would say it's a little bit mixed, especially when you look at this period versus this period. But now you are seeing a good 13,000 contracts come in. So Octavius holding through that period, assuming that he knew that there was more flows coming, was a good call. And my call, which was that we're not going to go much of anywhere at all, I'm not going to say that it was a bad call, but probably wasn't the best call, right? You didn't lose money that day. I can never say that it was a bad thing, unless like the market moved like 5 handles and I didn't take even a smidgen of it. Like if we moved 5, that would be impossible. I don't think that could ever possibly happen. 5 handles on like low liquidity, but like 5 handles in like high liquidity? No way. No way. Okay. Now we'll pop over to Reddit. Oh, I should check my eBay. There's this guy. I bought this thing on eBay, and they suppose it like it says that it shipped. But then whenever I come in and I look at the tracking, yeah. They printed the label and they haven't taken it. I guess I should send them a message. This person is probably just new with eBay and doesn't know what to do. But they haven't shipped it. That's a little frustrating. Is it possible to wind back the video and talk through the order flow at the ES high or treasury low? Well, but we're not at the low in ES yet, are we? And kind of the thing is that I'm not really looking for reversals, right? Typically, the kind of trade that I'm going to take is it's already kind of going. And I just get in before it really gets going, you know? So what we saw in the treasuries would have been a good example, or it ended up being a good example of that kind of auto-correlated order flow, but it was not one that I was able to predict, so it doesn't count. S&P 500, well, okay, so right now they're selling pretty heavily. Oh yeah, no, I do not like that. So what are we seeing in the S&P 500? So here's my chart in the S&P 500, okay? There's a lot of crazy stuff going on here because I have these indicators that attempt to show me what the market maker average positioning is. So what I can see here is that they were kind of bumbling around on the buyer's average position, but they have now come back. They're well below all of that, and they're actually stopping out. So once you get below that blue line, that's like, you know, market makers possibly having to puke. Below this line, there is no market maker that is long that is making money, is what that means. So, but look at the order flow. 25,000 net contract short. That's a lot. Like, many times we'll come in and we'll see a move, and you know, it's kind of gently long. So that is a pretty aggressive sell. And I'm not sure I have any kind of predictors of order flow that might predict that. I'm going to guess that it's probably like we are down, and so like some options are kicking in and they're causing flows, is my guess. Yeah, maybe I might have misheard you, but earlier talking about something about predicting prices. That's right. Well, so the things that are going to predict price are going to be the flows, right? Predictors of order flow. So the only flow that I have listed today is that flows are going to be relatively slow, waiting for CPI. So when we get something like a pretty consistent buy in the treasuries, or a pretty consistent sell in the S&P 500, it's, you know, well, there's going to be some flow behind that, but I don't know what it is, and it was not something that I was aware of before time, right? Are they indicators? Yes. These buyer, sell, and buy and sell positions, market maker average buy and sell positions, is called the inventory cost basis. Is an indicator that's available on my website as part of the paid package. If you go to the website and you download the package, you get a 2-week trial. I think I'm going to go and change the website a little bit and like make a download page so it's a little bit more clear what's available there. I don't think that the current website does a good job of that, but I digress. In the S&P 500, you got to realize that the S&P can be kind of wild. So it can kind of come around and do stuff all over the place, right? In the treasuries, I think you will find that this indicator can be pretty useful. Like, look at the number of times where it bounces off of these lines almost to a T, right? I guess we could count this one. It's actually unusual for them to go like 2 ticks through it like that. But it's almost eerie. In the treasuries, it's almost eerie how they will react to those lines. I can't predict, like, okay, so here we bounced off of this one. So does that mean that it's going to come to this one and bounce off? Or that it's going to come to this one and bounce? Like, I haven't found any way to predict that. It's just the number of times that I will see a pivot near that line is unreal. Like, so I always come back to this when we talk about price levels, right? What is the value of a line? Like, if I come in and I say, we're going to come to the previous day's point of control, how do I evaluate how effective that line is? Well, I could back test it, okay, but maybe my strategies and ways of going about that are wrong, right? Like, and how do you compare it to like this line or this line? I don't know. So perhaps one way that we could do it is we could say, how often or how close are pivots to that line? Well, so if that was the only metric, I think that my indicator would do really well with it. Yeah, so if you want to learn more about it, you just go to the website. So I'll pull that up. Yeah, I don't pull up the website on the live stream very often. Probably should more often. Okay, so I have Indicator Suite now available, free trial. You can come over here, and then, you know, it says download the file, and it tells you how to install it. If you're familiar with NinjaTrader, and then if you want to buy a full license, you come over here, and you buy it. It's only $100 for the full package. But if we come back to here, this front page, there is a detailed documentation. Inventory cost basis. Okay. Inventory cost basis attempts to model market maker behavior. Such market making strategies are placing limit orders at multiple prices to make money on the spread and must manage an inventory. When an order adds to a position, it is adding to the market maker's inventory. Similarly, when an order is taking profits, it reduces the outstanding inventory. The average price at which the currently outstanding inventory has been acquired is called the cost basis. The inventory cost basis indicator uses rules to model when market makers add to or take profits on their positions. From this, we can estimate the overall market's cost basis for both buy and sell side inventory. So think of it as like best and worst case scenarios on market maker positions, okay? We can also look at how much profit has been built up over the day versus how much inventory is currently outstanding to calculate an estimated break-even line for the day. That's basically how it works, okay? Have your indicators helped in your profitability? Absolutely. This inventory cost basis one is a little frustrating for me because when I look at it, it's like there is so much edge in this. It just seems like it turns at those lines so perfectly. But I haven't found a way to actually make money just from that. Okay. But some of my other indicators, I literally cannot trade without. Like a lot of the stuff that's included in this suite, I just don't get how people like. So I'm trading treasuries. If you're trading treasuries, I really think that you want to have a spread indicator of some sort of. I have a free version, but the paid version like auto rolls over and you can do candles with it and it'll work on like your volume profile chart right here. Right here I have the spread charted on a candlestick chart down at the bottom. Okay. Super important. I've come over here. We have the synthetic dollar index. Okay. How are you trading without knowing what the value of the currency that you're trading is doing? That makes 0 sense to me. You've got to be able to see the dollar. What this does is it uses the Forex futures to calculate what the dollar index should be. So the number that you'll get here will be different from what like the official dollar index will be because, you know, they're futures and they're a little bit different from the spot. But you'll still get the same movement and it'll tell you what the dollar is doing. It's super useful. Okay. What else? And then probably the next most useful one is like when I'm watching ZN from a day period, I have this multi-ATR. So like ATR by default gives you it in points, right? Like if I looked at ATR here, it'll tell me that it's like 0.43 or something like that. And it's like, well, what is that? That doesn't tell me anything. So I have an option to convert it into percentages or into ticks. So this one is showing me in ticks. It's telling me that on average, we move 36 ticks a day. And I can see where we are today relative to the average true range. Okay. And I also have the spread down there. This indicator, just ignore this. This was just kind of a test. I don't know if I don't typically look at it. Well, I did some testing to see if you could use this rate of change as a momentum strategy. And I've got some inkling that it works, but I would need to run it across multiple instruments. So there's still some work to be done there. Okay. Again, the inventory cost basis is cool. The rest of the indicators that are on there, did I close it already? No, I didn't. Oh yeah, Alice is another useful one. Okay, so Alice, what Alice does is like if you have a move where like it just moves really fast and it moves so quickly that like they just completely skip a price, like no volume occurs at that price, it's just like the offer completely pulled there, right? Then Alice will send a warning. And those tend to create liquidity holes. Like they're very likely to come back to those sorts of things. But it also does a really good job of alerting you to like something's happening in another instrument. So Alice is probably the next most useful one. Or sorry, not Alice. No, Alice is different. No, I use Alice too. Alice is this one right here. So in the S&P 500, Alice is basically, remember we were talking about like, okay, based on the amount of volume and the amount of volatility and yada, 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 what would be like the optimal number of contracts to trade to take advantage of this move if we knew that it was going to move up 4 points or whatever you want to put, right? Well, that's what Alice is telling you, is it's telling you the optimal number of contracts to trade for a 4-tick move. So it's saying right now that you would only want to trade 3,772 contracts. So that's a little bit low. That's actually a little bit low. So what it's saying is that the amount of volume that's trading relative to the volatility is not very good, and it's a little bit dangerous. So, but anyways, the higher this line is, the more opportunity is potentially available in the market, is basically what this means. So you can use it as a filter to when there's enough activity to trade or not. Okay, that's what Alice does. The one that I was talking about, and I don't think I think I need to put it back on this chart, actually. Is the hold prices. So this one, hold prices. Oh, I don't have a picture of the hold prices ones. Oh, okay. Well, anyways, I explained it, right? If there's slippage, then it will draw a box around the slip, and you can see, and they're likely to come back to those places. So that one's kind of a little bit more of alert. The rest of these, oh, okay, sorry. Range histogram is really, really valuable. This basically, how come I don't have a picture for that one? I'm so silly. Should probably go and try to improve the documentation a little bit with more pictures. Anyways, a lot of these, like the level 2 changes and level 2 tape and so forth, these are things that you can see on the DOM, and I would recommend that you watch the DOM and you kind of keep these things in mind. Like, how many level 2 change? Like, how often is the level 2 changing? Every time it changes, you can kind of see it dancing around a little bit, and you know, when it's just changing all over the place, like that's a really active market. That does tell you something, right? And those indicators are there to, if you want to try and, you know, automate things. If you want to create a robot that uses those order flow things, then those other indicators would be useful too. A synthetic dollar index is kind of like an inverse leading indicator. I wouldn't call it a leading indicator, but there is some inverse correlations to it for sure. Like, you notice that the dollar is up pretty big, and when the dollar started moving, the S&P 500 soon thereafter started following down. So, why the dollar is moving in this way, I don't know. Could be geopolitical fears. Could just be some fluke currency move, but it does appear to be moving the markets and affecting the S&P 500 in particular today. Did you post the note thing somewhere? The note thing. Oh, the risk manager? I don't know if I have that installed in my current installation, to be honest with you. Oh, I do. Okay. So yeah, what this does is you select your account here, and then you can come in and you can add a rule. So I can say, I want to, oh, how come well, it's been a while since I've added this. Okay. But basically then I can say, you know, critical, and it will, like, if it reaches that, then it will stop you from trading in that account. I've never really actively used it, to be honest with you, because I take all of my trades over here in ZN, That's why it was like, okay, this is something that people ask about a lot, so I'm just going to make it open source and put it out there. That's why it's there on GitHub. I've had a couple of people ask me about it, and I'm like, well, okay, this is what I've got. You know, it's like, consider it early alpha. Because the issue is anytime that you've got something that could potentially, you know, cause you to not take a trade, right? It's kind of on shaky ground, right? 'Cause then that could be responsible for the thing. So it's alpha. Use at your own risk. Okay. But if, and it only has one rule too. So you might want more sophisticated rules, but there's like a whole framework in there for you to do that and to add different rule types. So that's what that's about. There are also, I think there are some other platforms that have this sort of thing built in these days. And you can set up rules at your broker. So you might want to look at that. Probably better options. But if you want to do it in NinjaTrader, or you're a programmer and you want to pick it up and make it better and like submit pull requests and stuff, then go for it. There was hype about the solar eclipse well yesterday. But I'm still stuck on, did you post the note thing somewhere? Where are you talking about the note thing? Unless you're talking about my Helix editor that I have open here. But that's just my own personal notes. I don't post that anywhere. They just save them on my desktop and I forget about them, and maybe someday I will ingest them into some chat GPT or something and it will tell me things. I don't know. Yes, that. Yeah, this is called Helix Editor. It's just a text editor. HelixEditor.com. It's a command line based text editor. So what's special about it is that it allows me, like, I can move up and down, right? I don't know if you can see where my cursor is, but I can move up and around. And when I'm doing that, I'm using HJKL to move up and down. And then I can select a bunch of stuff and like delete it, undelete it, right? Basically, like, I can do everything that I'd ever want to do without ever having to take my hands off the keyboard, right? Because normally you want to, like, you know, you want to go into a different part in the document in Microsoft Word. I have to move my hand over to the arrow keys, or I have to move my hand over to the mouse, and that's kind of a disruption. So I like having something where I can just move around like this. And then if I want to actually write something, then I have to change modes. I press I to go into insert mode, and now I can type. And then I type JK to go back into normal mode, and now I can move around again. Delete that. Insert, return there, right? It's neat. So it's, I don't know if you really want to get into that sort of thing, there's an application called Vim that's been around since like the beginning of time. And Helix is just like a rethinking of Vim. That's all it is. It has lots of cool themes too. So in this mode you do colon, and now you can type commands. Colon, theme. Now I can test all the different themes. They added some new ones in the latest version. Yep, dark is kind of one of my favorite ones. That's what I was using before I found this current one that I'm using. That's kind of all blue. Anyways, helixeditor.com is the website for that if you really want. But like, I'm just warning you, that's like hyper nerd stuff, right? That's like, you've got to memorize all the key bindings, and it takes some practice. And all right, well, so with that, it's time for me to get going, guys. I'm sorry. I have real good discussions. Thank you for stopping by. Well, both Forrest and but a bunch of new people too. Asking really good questions makes the stream really good. So, and that's great for a day like today when, you know, we kind of expected it to be a little bit slow. Tomorrow is going to be CPI, and depending on what happens, it could be a little wild. So, you know, if the number is high, this market could really freak out. So I'll see you guys there for that. And in the meantime,